Daniel, how does your September change things? What's the nuance launching from August into the autumnal September?
Well, I think at this point, what's not going to change is we're going to have some hikes. And we focus a lot on, is it 75? Is it going to be 50? The payrolls data will inform that. But we really should be focusing on the objective of the Fed, which is to get growth down, to get inflation down. And of course, the interest rate hikes are just a means to an end. So in one sense, it's a bit of a distraction. It's whatever it takes, if you will, to get growth down, and not only growth per se, but really to get the job market back into line. With the recent JOLTS data, with the job openings, rose over the previous month. And so you still have nearly 11 million job gap between what employers are looking for and what employees are available. That means, continued high wage gains. That's going to fuel inflation, and that's just not sustainable from the Fed's point of view.
Is that the environment that you want to be buying stocks in?
For now, yes. So the real issue is going to be, we all anticipate this a recession next year, that is what it's going to take to get inflation down. But that doesn't mean you should necessarily be allocating for that at this time. So overall, we're still neutral on equities and have some markets that we favor. But at some point, yes, you are going to want to pivot. But we think it's really premature at this point to be doing that.
And why is that? Why do you think it's premature?
And typically, if you look at how markets react to recessions, it's really 1, 2, at most 3 months prior to when the recession starts that you start to see consistently negative returns for equities. 6 months out, 50-50 chance. Now, what's, of course, different this time is how much we all anticipate this recession, whereas typically they often catch us investors by surprise. So whether that time frame is going to be different this time, will that pivot happen sooner? More likely than not. But I think we're going to have to see more meaningful deceleration in the economy before that's likely to happen.
Dan, is this really at all about the economy, or is this about the Fed? I mean, yes, it's the economy, but the Fed wants to influence the economy lower. And Neil Kashkari came out and said he was happy to see the market sell off in response to the Jackson Hole speech by Fed Chair Jay Powell, and that he was disappointed to see the rally in previous meetings because this was not the goal. They wanted to see a tightening in financial conditions. How much can you push against that with this sort of backward look to historical performance of equities in the face of recession?
Yeah, well, absolutely. And I think what we're going to have to anticipate, of course, on one hand, we do have rates going up. That's increasing the discount rate. So that should have a negative impact on valuations for equities. We're not really seeing the growth impact yet. We talk about earnings expectations still, quite rosy for next year, 10% earnings growth year on year. And that's just something that's not compatible with the slowdown in growth that we think we're going to have to see. So it's that tension, what's going to be the catalyst to bring those two back in line, of course, is the big question. But we believe it's going to happen at some point. It has to.
Dan, what do you do with energy right now?
Well, we are, broadly speaking, overweight commodities. I mean, on one hand, in anticipation of a recession, that typically is an environment for lower oil prices because of lower demand, which certainly will still happen. But we're in a different world when it comes to the supply side. We're not seeing that supply side response. And we think the net effect of those two forces is for us still to be overweight commodities.
Dan, I looked at the Bloomberg Total Return All-In Global Aggregate Index today. And basically, with the price decline, yield up, we're back globally to where we were in 2011. State the case for ownership of fixed income instruments. I don't get it.
Well, you want to look at it still from a portfolio perspective. I mean, clearly the big disruption in the first half of this year was the change in the correlations, the positive correlations between equities and bonds in a bad way, with prices going down for both. We appreciate we're going through this transition of the 30-year bull market in fixed income to at least a bear market for a while. But, at 3% or a bit more for treasuries, we're getting to the point where we should have a stabilization of rates. And then from a portfolio perspective, it's still going to make sense. So, right now, timing, we still anticipate higher rates. We're short duration, but we don't think we have anywhere as far to go as we did over the last 6 months.
Dan, just quickly, just to put a bow on it, how would you respond to a bad print on Friday? Is bad news, bad news, bad news, good news? What is it?
It's going to mean that the hike is 50 instead of 75. It's good news relative to the 75, but it's still 50, and that's what's going to matter.